So thank you very much for having our paper on the program. This is joint work with Christine Palur from UC Berkeley. And we want to talk about minor collusion in Bitcoin. So decentralized finance came up with this idea of creating value by cutting out the middleman and making things more efficient. And in this paper, we want to look at whether DeFi, decentralized finance, can deliver for this promise and really can create value for consumers. So finance is often thought to be inefficiently competitive. There's a lack of competition in several fields of finance. A few papers have studied that. And so we can look here at a setting where there's free entry, no trust, no regulation, and we want to look at how competitive finance is in that setting. So we use Bitcoin as an example because it's the biggest cryptocurrency. It's the most widely and first adopted DeFi system. So that is an interesting um, sample to look at. So let me give you a few highlights of our results. So first, I wanna show you some evidence that Bitcoin is actually not capacity constraints. It seems like, in fact, that miners seem to leave money on the table. But we would argue this is not because miners are irrational. We would argue that this is a result or is consistent with an equilibrium where miners actually price discriminate between users and collude to extract higher fees than they potentially could. So we do a back of the envelope calculation and we find that about $550 million in excessive fees have been paid on Bitcoin. And so this is an economic significant order of magnitude. So let me talk a little bit about what we do in greater detail. So we look at all the blocks from the Genesis block until November 2018. So each block has this Coinbase reward, which is the reward for finding the block. We don't look at that. We are more interested in the transactions that come with it. So in each transaction, there's Bitcoins being sent from the from addresses to the to addresses. So we have about 350 million transactions in our sample, which has over 900 million input addresses and 960 million output addresses. And the fees that the miners can keep for themselves are the difference between the amount of Bitcoin that is sent from the from addresses and the Bitcoins that are received by the to addresses. And that's what the miners can keep for themselves as fees. So let me show you a few stylized facts. So this is a zoom in on the time when I must now say the previous peak of Bitcoin in 2017 when Bitcoin was trading at close to 20,000 US dollars. And this is a cross-sectional cut of the fee distribution. So on the left side, we see the lower end of the fee distribution. So what you see here is the minimum fee and the lower quantile of the fee distribution. So the median is here, this kind of turquoise line here. And what this was the peak time of Bitcoin, where there was a lot of transaction demand, where everybody wanted to trade Bitcoin because Bitcoin was had such a high price. And so this, if anything, this was the peak demand time. But we do see that the median fee is actually for most of even that peak period around $20. So here at this point, it goes up above $30, but the median fee is not that high. If you look at the right panel, you see the right end of the distribution, and you see that the maximum fee that people are willing to bid at the same time is truly exorbitant. So we see that fees over $10,000 are being paid at the same time by some people to get their transaction processed. So for us, it's a little bit puzzling because you can observe what other people are bidding when they post their transaction in the mempool. Why would somebody bid thousands of dollars to have their transaction processed when they see that other people pay $10 or $5 or $20 to get their transaction processed? Of course, if you're keen and you want to make sure that your transaction gets processed. You want to outbid the others, but why do you bid $10,000? That is not very obvious to us. Now, is this really congestion driving this? And we would argue no. So in the green line here, what you see is the fraction of empty blocks. So this goes from 0 at the bottom to 100% at the top. So initially, of course, nobody was using Bitcoin. So when it started and all the blocks were empty, but over time, transaction demand picked up, and we see that the number of empty blocks falls. What is interesting is that the number of empty blocks never reached 0. So even at this peak time that I just showed you before, where some people are willing to pay thousands of dollars to get the transaction processed, on that day, empty blocks were being mined. So um, we find that about 1.1% of the blocks in the Bitcoin network are empty, and it's very hard to explain this with technical difficulties. So miners now use what's called the fiber network, which allows them to exchange information on blocks and transaction data in near to the physical speed of networks. So there's no delay in networks. We're talking here about really a few milliseconds at best for physical kind of limitations on the network. So this is not driven by technical problems that these miners have. They run sophisticated operations. We also see that if you look at the average block capacity, that's the orange part here, we see that this goes up over time. And at the peak of Bitcoin, which Bitcoin price is this shaded gray area in the back, when the Bitcoin price peaked, yes, we see that blocks are fuller, but blocks are not totally full. So the red line here shows you the fraction of full blocks, and we use a pretty generous definition of full. So if two average transactions don't fit into the block anymore, then we call the block full. So we see that there's very few blocks that are actually really full. So could this be because there's a lack of transaction demand? So we look at mempool data, and we find that the mempool is not empty, so the blocks are not empty because there's a lack of demand. In fact, we could fill up about 78% of blocks could have been completely filled with the transactions that were waiting in the mempool, and another 20% could have been at least partially filled with transactions from the mempool. So we see that there are transactions waiting in the mempool, but they somehow don't get included into the blocks by miners. So what we can do now is we look at how much would have the miners made if they would have filled up the blocks with the transactions that we're waiting. And we find that this is about $55,000 a day. And so if the total fees in our sample, to give you an order of magnitude, are about $830 million. So the money left on the table is about 38 million. If we look at that. So that seems puzzling. Why do miners seem to leave money on the table when they could have made more money by including these transactions in a block? To understand this, we build a little theory model in our paper. So in this theory model, we have two types of agents, a patient agent and an impatient agent. So the impatient type has a higher cost of waiting. They are really keen to transact. They want to transact now, but they also have a greater utility for having their transaction included in the blockchain, which means they are willing to pay a higher fee to get their transaction included. So the agents arrive at the market, submit a bid, they cannot change their bid, and the miners go and select the transactions that they want to include in the block, and this is how blocks are formed. So we look at two different mining rules in our paper. So the first one is competitive mining. This is what many people assume in the literature. This is what Satoshi Nakamoto had envisioned when Bitcoin was created. So what would happen there? So if miners are truly competitive, two outcomes are possible. So if there's no capacity constraint, you know that the miners will include your transaction as long as you bid an epsilon in fees. So what will happen? Why should you bid $50 when you know that there's no capacity constraint and everybody gets in? So in equilibrium, all the bids will be zero, all the transactions get included. So uh, we see that there is not really a capacity constraint at the moment, but we do see positive fees, so we don't think that's what's happening. Uh, if there is a capacity constraint, what would happen then? So first of all the blocks would be full, which is not really what we see. But what how would bidding behavior be then in equilibrium? Well, we have the impatient type and the patient type, and just uh, all that the impatient type has to do is set themselves apart from the patient type. So if you know that the patient type is at most willing to pay $5, you just have to bid $5 plus 1 cent, and then you know that you're better than the patient types, your transaction will be included and will execute immediately. So you just pay a little bit more, the impatient types just pay a little bit more than the patient types just to set themselves apart, to get their transaction into the blocks. They execute immediately, and they are the ones that are keener to do. So the patient types get rationed and they wait in the blockchain. They have to wait in the mempool to get their transaction processed. So what is the big implication of this? Well, if this is true, then we should see a fairly low bid dispersion, because the people that are very keen, the impatient types, they just bid a little bit more than the others to sell themselves apart. So bid dispersion would be low. Again, that's not really what we see in this stylized evidence that I showed you before. What we are thinking more is going on is that miners strategically manipulate capacity. So how can you think about the miners now trying to extract as much value as they potentially can from those two agents? How can you do that? Well, if the miners collude, they could say, well, if you want to be included now in the next block, then you have to bid as much as you're potentially willing to bid. So the miners extract the full surplus from the impatient types. And so they say, well, you have to really, really bid a lot. For the patient types, how can you price discriminate? Well, the patient types, you just delay the execution of their transaction. How does this work? Well, the impatient types don't want to wait, so this is not an option for them. And this way you can separate the patient types from the impatient types and effectively charge them two prices. The impatient types pay a high price and execute immediately. The patient types have to wait in the blockchain and they pay a lower price instead. So in this equilibrium, two important implications that are consistent with the stylized facts that we see. First of all, we should see a very high bid dispersion because the impatient types are bidding as much as they're potentially willing to bid, and the patient types pay a low fee and have to wait in the blockchain. And the other thing that we see is that there is excess capacity in the blockchain because you have to delay the patient types. So even if there was space in the blockchain, you cannot include them to sustain this equilibrium. You have to delay their execution. Otherwise, all the impatient types would pretend that they're also patient types and the equilibrium would collapse. So what are the main implications of this? So if we believe in this discriminatory service, then the blocks would only be partially full. There would be high fee dispersion. And I think I showed you some evidence for this. And the other implication from our discriminatory equilibrium is that the fee dispersion increases when the impatient types are keener to transact. So if the impatient type is really, really keen, then the miners can extract part of that value in discriminatory pricing. Remember, in competitive pricing, the impatient type just has to bit, an epsilon more than the patient type. So it doesn't really matter how keen the impatient type is to transact. That doesn't really affect prices. Only in this discriminatory servicing, we should see a difference. And for the remaining talk, I'll present you mostly evidence on this third point here. So in this example here, we look at the days of the week. And what we see is that on weekdays, and especially on Fridays, where also the Bitcoin futures settle in the US, we see that there is a higher fees being paid. And on the weekend, we see lower fees. And we also see that there is higher fees being paid during the opening hours and trading hours of Bitcoin futures at the CME. So we would argue that is consistent with institutional investors, hedge funds trading in these in Bitcoin, and because uh, uh, they are more keen to transact, they're willing to pay higher fees, and so that shows up in the data. The miners are able to extract part of that surplus. So the next thing we are looking at is that payment that fees actually increase with the uh, degree of the kimchi premium when the payment is made to an exchange. So what is the kimchi premium? The kimchi premium is the price difference of Bitcoin in the US and in Korea. So they don't always trade at the same price, and very often we do see that Bitcoin in Korea trade at a much higher price than in the US. So this presents an arbitrage opportunity, and people are very happy to move Bitcoin to Korea to sell them there for a premium and pocket the difference. So what we document here is that if the payment is made to an exchange, uh, then and the kimchi premium is high, then we do see that these transactions pay higher fees. So this is consistent with people that are very keen, because these arbitrage opportunities don't exist forever. And if you see that, if the market is in such a way that you can capitalize on this price difference, then you want to move fast. And we do see that. So you have to move your money from an exchange in the US or from your private wallet into a Korean exchange. And so we see that these transactions, these users that engage in these type of transactions actually pay a higher fee. Furthermore, we see that this fee is increasing in the kimchi premium. So the more keen people are to do this, the higher is the fee that they pay. And we don't see that happening to other transactions that happen at the same point in time. So it's really that the miners seem to be able to extract that extra fee from those people that are very keen to do that. So is this how is this related? This is not only a demand side story that is driven by people who want to transact. This is also driven by the miners and their ability to collude. So like in most collusive equilibrium, it's easier to collude if the concentration is high, if there's fewer players in the industry. So we see the rise of mining pools is becoming is one of the stylized facts we observe in the data. And we would argue that mining pools are, for all the other benefits they have that have been discussed in the literature, one benefit is that they enable this collusion. So here we see that fee dispersion, meaning the difference between in the context of our model, the fee that the impatient types are paying over the patient types, that this fee dispersion is actually increasing in mining concentration. So we have two measures of mining concentration. We have the Hirschman-Hurfendahl index of the market shares that the different mining pools have in Bitcoin mining, and we also look at the aggregate share of blocks that are being mined by mining pools. So both measures, we see that the fee dispersion is increasing in mining concentration. We also have some other evidence on capacity management. So Bitcoin, we know on average, a block arrives every 10 minutes, but in reality, the variation between blocks is quite large. So there's many cases where it takes more than 2 hours for a new block to arrive, and sometimes a new block arrives in a matter of a few seconds or a minute. So there is a huge variation in this time. So if we look at it's not a surprise that in a way that if there is very few blocks that arrived recently, that the next block that arrives is fuller because if there's a long waiting time, then there's more transaction demand, so the next block will be bigger, and we see that in the data. However, so if there's few blocks arrived, the next block is larger. If there has been many blocks arrived, so if we look at the high tercile of recent blocks, we see that the next block is less full. However, once we interacted with mining concentration, we see that this effect is only present when mining concentration is high. So, and in fact, in this situation, it is even larger and more pronounced than before. So when miners seem to actively manage capacity, so when mining concentration is high, we do see that the blocks are fuller when there have been few recent blocks, and they are emptier when a lot of blocks have arrived recently. So miners seem to play a role in this capacity management because this effect is only significant when mining concentration is high. So we also have some direct evidence from tracing transactions from the time they entered the mempool to the time they showed up in um, the blockchain. So we run our own Bitcoin node and we trace transactions from the time when they enter until the time when they show up on the blockchain. So we see that if you are in the top 5% tile of the fee distribution at the time when the transaction entered the mempool, that the waiting time is pretty low. So most of the transactions, over 80% of the transactions, get mined in the next block. So we see that that the high fee transactions get processed much quicker. If you are in the bottom 5% of the fee distribution, then you have to wait a significant amount of time. There's a high chance that you might have to wait a few blocks to get your transaction processed. So the market seems to be aware of that. There is a lot of these websites that allow you to estimate uh, fees for Bitcoin. So you can say, well, I'm willing to wait 6 blocks. If my transaction is this big, how much should I post in fees? And they give you advice on how much you have to pay depending on your willingness to wait for a certain number of blocks. So just to finally to show you that this is a non-trivial amount of money that we are talking about. So we have about $840 million in fees for the that are being paid in our whole sample. And we do a little back of the envelope calculation, which admittedly is pretty rough. But if we say that if the miners are not able to extract that extra fee from the very keen types, then the keen types would pay just a little bit more than the patient types. And we just arbitrarily set the threshold for what the patient types are willing to do at the 10% quantile of the fee distribution, but we worked with different numbers and the results are pretty similar. If we look at that, just as an illustration, we think that about $550 million are being paid in excess fees on the Bitcoin network in our sample. So to conclude, this blockchain setting allows us to examine a completely unregulated market, and Bitcoin came with this great promise to increase efficiency, and decentralization increases competition. Well, we first of all, we document that there is this consistently underused capacity on the Bitcoin network, and the empirical evidence that we have seems to be consistent with actually some price discrimination happening, and that is not really consistent with this very competitive behavior that people envisioned when these decentralized finance networks were being created. So one last thing that I want to say is that we cannot really take a stand on whether this is good or bad. Uh, we could One potential story is that these excess fees could lead to greater investment into mining infrastructure that makes the system as a whole safer, that could raise the utility of all the participants in Bitcoin and could potentially be a fair benefit that people receive for paying these higher fees. So it's not totally obvious that this is a good or bad outcome. Um, we cannot really take a stand on that, but we do document that there seems to be some kind of show some evidence that's at least very strongly consistent with this idea of price discrimination in Bitcoin fees. Well, thank you very much. That was it. And when I head back to the
Hi, no,
panelists.
hi, thank you very much, Alfred. We have already one question that is on the Q&A. Can you see it?
Yeah, do you think that we can reach an international um, revenue model for mining pools? I think that would be a very interesting proposal. Um, we can think about that would be nice. It would involve some international coordination, which is notoriously hard in these decentralized finance applications. And a lot of people actually move to this decentralized finance because they want to avoid government regulation. But it seems that if this problem gets worse, and you can think of various ways in which miners could abuse their position to extract more revenue, then there will be that the trust in the system will be eroded, and there will be a call for greater government regulation. Whether this is really doable is another question, I think.
Thank you very much. Also, one from me. I mean, we've talked about minor collusion in this respect with fees and so forth, and unused capacity. I mean, in general, there's been some research that's also suggested that indeed minor collusion or indeed mining pool concentration has been above the 51% required to actually take over, to actually lead to an attack on the network. And also, in fact, that the majority of this may be concentrated in China and the effects that that may have on in fact, regulatory input into control of the Bitcoin network, in a sense. Do you have any thoughts or opinions on this?
Yeah, there's certainly a security aspect to this increase in mining concentration that we don't really touch in our paper. So we touch more on the economic side of that, but there is a huge security problem if anybody would ever reach this high threshold, or if two mining pools that seem to be unrelated at this point in time collude so that they can have more than 51% of the hashing power. That would open up the system for an attack. Now, here is probably where there is a benefit of this collusion that we document in our paper. If the miners can comfortably extract good revenues in fees, that of course create some kind of charter value for them, right? So we know that in any less competitive system, there is an incentive to keep that system going. So that probably reduces the incentive of the miners to stage an attack for a one-time benefit, but they rather want to milk the system as it is. So in that sense, collusion could provide here as a force of stability into the system that might benefit everybody.
Okay, great. So that the concentration, and collusion goes both ways in that respect, I suppose.
I think so. I think so. If you as relates back to this older question about competition in the banking sector, where people have argued that a less competitive system is actually, in one sense, good for financial stability, because if there is less competition, then banks have some charter value, they have some rents that they can get from the banking system, and they have less of an incentive to engage in excessive risk taking. So here we have a similar story where the lack of competition creates these charter values and reduces the incentive to commit fraud or a 51% attack.
Great. Thank you so much for a fascinating presentation, Alfred. It was very insightful.
Thank you very
Moving on
much.
then. Thank you.